For high-income earners, contributions to a Roth IRA are typically off limits. But as luck would have it, there's another way for these individuals to take advantage of Roth contributions, and it's called a backdoor Roth. So how does this work? For 2024, singles earning $146,000 or less, or married couples earning $230,000 or less can contribute the full $7,000 to a Roth IRA. The backdoor Roth IRA comes into play when, due to your modified adjusted gross income, you make too much to contribute to a Roth IRA. Single taxpayers earning more than $161,000 of MAGI, or married couples filing jointly earning more than $240,000 in MAGI are not eligible for Roth IRA contributions in 2024. So for those falling into this category, let's explain how to utilize a backdoor Roth. To do this, you need a traditional IRA account. After that, it's a two-step process. The first step in a backdoor Roth IRA is to make a non-deductible IRA contribution to your traditional account. You would then want to use the IRS Form 8606 to report that contribution to keep the tax status of those dollars intact. Step 2 would be to make a conversion. Traditionally, when you do a Roth conversion, you pay tax on the amount converted because you received the tax deduction at some point in the past. Using a non-deductible IRA contribution, you've already paid tax on that amount, and the IRS will not tax you again. So at conversion of a non-deductible IRA contribution, you're only paying tax on any gains. Let's look at an example. If you make a $7,000 non-deductible contribution to a traditional IRA, and over the course of the next few months that $7,000 grows to say $7,200, you would pay tax on $200 worth of gains when you convert to a Roth. This is why when we are doing a backdoor Roth, we usually convert immediately after contribution, so there will be no gains. The biggest thing to look out for in the backdoor Roth IRA is the aggregation rule. This rule states that the conversion must be done on a proportional or pro rata basis, meaning your tax liability is based on the total value of all your IRAs, not just the assets you want to convert. Let's look at another example. Let's say Charles has $72,000 in a traditional IRA, and it includes $5,000 of non-deductible contributions he made this year. Charles is wanting to do a backdoor Roth IRA and says, well, I'm just going to convert the $5,000 contribution I made this year to the Roth IRA. But because he has existing traditional IRAs, the pro rata rules apply. So Charles' conversion amount he wants to do is $5,000, but he has a $72,000 traditional IRA, so only 6.94% of that amount is deemed after tax. We calculate this by dividing $5,000 by $72,000. So if Charles does a Roth conversion of $5,000, he's only going to have $347 of that $5,000 deemed after tax. The other $4,653 of conversion will be a taxable conversion at his ordinary income rate. This sneaky little rule gets a lot of people when it comes to backdoor Roth conversions. One way around the aggregation rule is to not have any traditional IRAs. 401k plans do not count towards the aggregation rule. So if you have a large IRA, you could actually roll that into your company's 401k and not have it count towards aggregation. Now there's a whole set of other issues that arise there, but it would get those dollars out of the aggregation arena. Now every situation is different. The only way to really see if this is something that would work for you is to speak to a financial advisor and put it through a financial plan. Having tax-free dollars grow in the Roth world could be advantageous, and we actually show that in a previous video. If you have any more questions, you can email us at education@thenoblegroup.com, give us a call, or visit our website at thenoblegroup.com. Don't forget to like, subscribe, and turn notifications on to be informed when each new video drops. Thanks for watching.